despite Chinese economic growth continuing at rates above 7%, or slightly below 8% at 7.7% for the first quarter of 2013. Commodity prices and the valuations of resource companies have seen sharp declines in the last few days. So what has changed the market's mind? Adrian Saville, as I said, Cannon Asset Managers, joins us in studio to discuss the outlook. And I've had some very worried market commentators on the desk over the last couple of days. Is there something really untoward happening here, Adrian?
Yeah, Bronwyn, I think that the untowardness, if there's such a word, has been going on for quite a while. And it really is I think Michael Power described it as the water world of liquidity, that there is a world that is awash with money, and this money is being pumped into the system to try and, I suppose, lever sentiment. And Japan is a great case in point, that early this year there's a 1.4 trillion injection into this 20-year-old recession in the case of Japan. And the solution is more liquidity. And the liquidity is being used as fuel for sentiment. So this is a highly sentiment-charged environment.
Adrian, I think the initial response to the Central Bank of Japan printing more money was actually, the markets seemed to take it as quite positive. I think if we look at the Nikkei and the Japanese equity market. So
yeah.
You sort of indicated a little bit of caution there. Do you think this is a policy that's going to add to this problem that Japan have had for the last 20 years?
I love the way you couch it there. The Nikkei is up, sort of 30 or 40%. It's a pretty positive reaction. It's not sustainable. It really is a nonsense. And nothing that's going on in the advanced ailing economies really addresses the true problems, which are structural in nature. It's just more and more antibiotic and band-aid to try and nurse this patient to some eventual recovery. I really can't see where that recovery comes from in the absence of structural adjustment. And structural adjustment, ask most emerging economies, is painful. So you kick this can down the road for as long as possible. And if you're able to throw more money at the problem, you throw more money at the problem.
Let's talk about China. How big a problem are we facing in that territory? The market has got their knickers in a knot about that 7.7% growth rate, just slightly off expectations. It's still really robust. And we also know that it's a manufactured slowdown.
Bronwyn, I think, this gives perhaps some weight to my observation around sentiment, because in the second half of 2012, something really interesting happened. For the first time in modern economic history, the emerging world is bigger than the advanced world in terms of contribution to GDP. So we now have global GDP where the balance of contribution comes from the emerging world. The emerging world this year should probably grow at about 5.5%. The advanced world is growing at maybe 1.5% this year. So 50% of 1.5% gives you a contribution to global economic growth of 0.7%. And then 50% of 5.5% gives you the best part of 3%. So the world economy in 2013 will produce 3.2, 3.3% economic growth, almost all of it contributed by emerging economies. But the news flow is about the sick advanced world. And so sentiment is very anxious, everyone's on the back foot. Imagine if the advanced world were growing at 5.5%. What would sentiment look like then?
Adrian, this is, I think, the point really, and I looked at the chart for the Resi index today. From December, I think it's off about 20%, and that's in Rand terms. So obviously there's a currency effect there. But how can this be that we see not only the resource counters selling off, but also gold? You talk about this printing of money, and yet the gold price also went for a $200 roll tumble in the sand there. So
it followed Bitcoin down.
But gentlemen, and this is a point I've been driving home with everybody that I've spoken to about the gold story since Monday's sell-off, is that let's look at gold as a currency rather than a commodity in this discussion.
Sure.
If you like that.
Absolutely, and I don't really see any commodity function for gold. Gold is truly acting as a stable, reliable currency. And because it is traded, though, you get this dramatic volatility. And of course, if the US dollar bumped around 10% on the day, there would be absolute drama. There would be blood in the streets. So this is a very big disruption in terms of monetary stability or reading of monetary stability. But the broader commodity question, the emerging world, this 5.5% growth contributor, is very hungry for commodities. And for that reason, I am surprised at the extent of the sell-off. If you add currency weakness, rand weakness, into the equation, that should offer some relief. In fact, it's offered very little. Right. Investors have gone in the opposite direction. They've sold off the currency and the commodity businesses together. So it's hard to figure out what the, I suppose what the logic is, and the fundamentals don't add up. As a consequence, if I look into our portfolios, we're overweight in resource positions. And that overweight represents the structural demand that we see resident in the emerging world, and the fact that the structural demand is going to be in place for a very, very, very long time.
And that's obviously, I mean, we all know about how big China is as the consumer of commodities. And, people are talking about the change in composition of the resources they need going forward. But this is the world's second biggest economy we're talking about. You can't just chop and change the demand for the commodities in a heartbeat. I mean, surely this is a process that takes years as well.
Perhaps. If the platinum price goes from $1,500 to $3,500, then at that point, substitutes kick in. But as long as the platinum price hangs around under $3,000, manufacturing firms may be reluctant users, but they're not going to switch across to other commodities. And that's the case where you do have alternatives to platinum. In many cases, you simply don't have alternatives, or the alternatives are approximations of each other. And you can think here of the energy commodities.
I just wanted to backtrack a moment. So you've put forward the case for emerging markets and how they have swung the equation when it comes to GDP for the global economy firmly into emerging market favor. That, Adrian, is the underpin as to why you are invested in the resource story, and you believe this resource story is going to continue. Is that correct?
In part, there are other elements, and if we can come back to your gold observation, it's not just gold that I think is a currency. Anything that sort of stores inherent value.
Even whiskey.
If you can store that for long enough. Anything that you can store that will preserve its fundamental qualities, and that you can trade at another time, and ideally the articles are quite similar, so that you can't distinguish my bar of gold from your bar of gold, or my barrel of oil from Warren's barrel of oil. Then you've got versions of currency or quasi-currencies. So these commodity stories, I read them as having two elements. The one is a functional economic role, which ultimately must be the real reason for investing. And whilst they are establishing the weight of that economic role, they serve as quasi-currencies. And in a world that you've got the sentiment washing around the bucket, I would much, much rather have a producer of oil or gold or platinum in my portfolio than a whack of US dollar.
Or you have the physical, and that means we've got to buy a warehousing stock, because if we've got to stock our barrels of oil and our bars of gold, then warehousing is obviously a theme we've got to investigate.
That's it. I think, Adrian, we talk about this quantitative easing and unintended consequences. I wanted to get your perspective on something relating to that, and that is we've had Costa Vayenas from UBS was on our show last week. He talked about the dispersion of expectations for inflation in the UK widening. So in other words, people becoming less sure of what inflation is going to be going forward than they were 5 years ago. And one of the reasons he attributed to that was the fact that the kind of role that central banks have taken on now has made it a little bit unclear as to what their real primary purpose is. I wanted to get your take on whether you thought the distinction of what a central bank is supposed to do has wavered, has become less clear from this whole episode of quantitative easing.
Yeah, I think that's an intriguing question. I think I could, to volunteer a couple of ideas. The first one is just think about Governor Jill Marcus's observations around the role of the South African Reserve Bank, where it appears our central bank is increasingly interested in facilitating economic growth, not just managing inflation. Look at the Bank of Japan earlier this year, where it's quite clear, far from managing inflation, they actually want to engineer inflation. So I think that these mandates have crept, and the creep, when we look back now from where we are, I think the creep is pretty evident that these central banks are much more interested in engineering supports for economic growth. The Fed is on the same agenda. The European Central Bank is on the same agenda. I'd challenge you back to name a central bank that isn't trying to engineer a real economic outcome as opposed to a monetary economic outcome.
It's impossible to judge when we're going to need to take the pain from a timing perspective, isn't it? In terms of kicking this can down the road, how long can that keep going?
Well, Greece is still in the Eurozone, so...
So Cyprus.
Well, Cyprus apparently is selling all their gold reserves and creating huge fall-off in the price.
Bronwyn, I think if we knew that answer, we should be at home, waiting for the event, and we would have those bets piled on. I don't know anyone. It's impossible to tell. It is impossible to tell, and I don't know anyone who can offer you evidence that they've got the answer as to when this structural pain really kicks in. Ideally, you'll actually have desynchronized structural pain, as opposed to synchronized structural pain. And that is that the US is able to limp along for a little while whilst Europe gets its stuff together. And then Japan is already out of the woods and in the clear and running. So that you don't have synchronized or coordinated structural pain. So you can hedge your bets by diversifying geographically? You could hedge your bets by diversifying geographically, but once again, it's very hard to know which one of these will opt for it and come through structural adjustment the quickest. In examples of structural adjustment, Southeast Asian economies got through the structural adjustment of the 1990s in a couple of years. Sub-Saharan Africa took 3 decades to walk through structural adjustment as an aggregate. For the advanced world, I'm on the 2-decade wagon.